Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. On today's episode, I'm going to be giving you a full overview of all of the things that you should understand about costs and profitability. Because if you've tried doing accounting before, you'll know that we have many different definitions for what costs are. And so in this episode, I'm trying to consolidate all of the different definitions around costs so you can identify which one relates to what thing, and you will know how to track them in managerial accounting. So let's get started. First, what you should understand is the basic definitions around cost, price, and value. So cost is going to be the amount that you spend on something to produce it. Then the price is going to be your financial reward for producing it. And then the value is what the customer believes it is worth to them. So there are going to be three completely different things, but what we want to focus in is the cost. So the amount we're spending in order to produce either a good or a service. And so you can think of costs as a sacrifice of resources, and they are only going to become expenses in financial accounting when they are associated with the goods or services that are sold, and then you have to match the cost against the revenue. So these are going to be financial accounting principles, but it's important because we have to differentiate expenses from costs. So costs are just sacrificing the resources you're paying for something right now, but it will only become an expense once the goods are sold. We have to know first what is the cost object, because this is going to be a basic definition that will give us the cost of something. Therefore, the cost object is going to be the activity or item for which a separate measurement of cost is desired. So this can be either a product or a service. And the cost object, which is the cost of something, is going to be different from the cost driver, because this is going to be the factor whose change will cause a change in the total cost. So the cost drivers are technically related to cost objects, but they are broader measures. So they are production, sales, variety, whereas cost object, it's going to be the actual product or service. And so I hope these two are clear. Cost object is the thing. The cost driver is the factor that will cause a change in the total costs. So production, sales, or variety. Now, what we have to know is that the total costs are going to be a sum of all of the direct and indirect costs that come from a good or service. And how are we going to differentiate direct versus indirect? Mostly around the traceability that you have. So how much can you trace the costs back to something? Direct costs are going to be economically feasible to directly trace into the cost object, while the indirect costs cannot be easily traced, and it must be allocated, which will be something that we'll talk about later. Also, we're going to have two other differentiations regarding this cost jargon, and it's going to be variable costs or fixed costs. And this ones I already talked about in my previous accounting episodes, but I also decided to include them in this episode just because we're doing all of these broad definitions around costs. So, variable costs are going to be those that change directly in proportion to changes in the volume of a cost driver. So that means if I do more of this product, it will be seen in variable costs, while fixed costs are going to remain unchanged for a given period, regardless of the changes in the volume of the cost driver. So even if I am producing more of my good, I still have to pay the same amount of rent in my factory, let's say. So this is going to be the difference between variable costs, those that will be changing, and then fixed costs. But we could also do a deeper dive into each one of those too. So variable costs can be broken into two: true variable costs or step variable costs. So true variable costs are going to be those that are going to change directly in proportion to the level of production activity. So these are the ones that we usually think of as variable costs. But step variable costs are going to change, but only in large amounts. So it increases only with fairly wide changes. So one example of these might be, for example, a machinery cost. So even though machines can be seen as fixed cost or variable cost, it depends on your company. What we know is that machines have a specific amount that they could produce. So they may be fixed until a point, but then when you increase production at a specific point, it's going to also increase along with it. So these are going to look like steps because they look fixed and then rise and then fixed and then rise. So they are going to be costs that are constantly changing. And more examples to this may be marketing costs. For example, for a software company, it may be cloud costs. So you may have one cost for a specific capacity, but as soon as you increase the good or service that you're creating to a different range, you will have to add more to those. So these are called the step variable costs. So make sure to know whether the one that you're doing is fixed or it becomes a step variable cost. Now, if we look into the breakdown of the fixed costs, we're going to see that these ones, as I was telling you, they remained unchanged a little bit. But we have also two types of fixed costs. These are going to be the committed fixed costs, and these ones cannot be easily reduced without significantly impacting operations or organizational goals. So these ones, you are committed to them. That's why they are called fixed costs. But there's another category, which is discretionary fixed costs. And these ones, we can reduce them a little bit more easily in the short run without significant changes into operations. And so why do you want to differentiate fixed costs in your company? Because committed ones, you won't be able to reduce. But discretionary ones, maybe you're able to reduce. And this is going to be crucial for improving your profitability. So make sure that in your company, you may identify all of this type. So discretionary fixed costs, committed fixed costs, step variable costs, and true variable costs, because just identifying variable costs or fixed costs won't be enough when you have to make strategic decisions. When you have costs that are both fixed and variable, we can say that there is a change in the total, but not proportionally with the changes in activity level. These are going to be considered mixed costs, and they are also going to be important. But don't get confused with this ones when you're looking at your cost structure, because the cost structure is going to be the proportion of variable costs that you have versus the fixed costs that you have. So this will allow you to see how flexible your costs are, and it will, of course, impact profitability decisions, as we'll be studying later. Besides from this, we have other 6 terms that you should remember about costs. And so first one is going to be the product costs, which are going to be all of the costs involved in the purchase or the manufacturing of a product. Then you may have the period costs, and these are going to be costs that are expensed in the income statement in the period in which they are incurred or accrued. Then third, you're going to have inventorial costs. So these are going to be costs that will end up on the balance sheet as the inventory. So they may be assets, raw materials, work in progress, finished goods, or it may also be cost of goods sold as an expense. And then you may have these ones, which are going to be very important. These 3 sets that I'm going to explain are going to be extremely useful for decision making. The previous 3 were important for financial accounting, but now these ones are mostly for decisions. So first, it's sunk costs. And maybe you've heard about these ones, but they are past costs that have already been incurred and are irrelevant to future decisions because they cannot be changed. And so people tend to take decisions based on the sunk costs, but that's a big mistake because they already happened, and so they are irrelevant to our future decisions. So make sure that when you're taking any strategic decision, you are not incurring into sunk costs. Second type is going to be opportunity costs, and these are going to be the maximum that could have been received by selecting an alternative use of resources. And so let's break down into normal words. Opportunity costs are going to be that maybe I have 2 projects, and by making one of them, I'm not only incurring in the cost of this one, I am also incurring in the cost of not doing the other one. So if the other one was more profitable, this was more costly. And this is going to be a concept that you can apply in anything in your life. So you could be listening to this podcast or sleeping. What is the opportunity cost to that? You have to consider this as the cost of the opportunity that you didn't take. So maybe if you didn't sleep last night, sleeping would be more relevant. But if you want to learn about budgeting, then this is going to be way more relevant. And so all of these opportunity costs are going to be considered the best alternative that you had. And so it's the maximum that you could have been received. And what you always want to consider is that opportunity costs shouldn't be very high, right? Because if they are very high, then you made a bad choice and you should be doing the other thing instead. But opportunity costs are going to be crucial for decision making. The last concept that I want to talk about costs are going to be relevant costs. And this one will be very important because there's a method called relevant costing method. But this is going to be costs that are differing between 2 alternatives. And they're going to be future-oriented, incremental, so they are incurred by a decision, and they are also going to be impacting the cash flow. So you have to remember these 3 things. They are going to make them relevant. So I'll repeat them. They are future-oriented. They're going to change depending on the decision, and they're going to be impacting cash flow. All of these costs are going to be considered relevant costs. In my next episode, we're going to talk about all of the analysis that you can do regarding costs or profitability. But the one thing that I also want you to take away from this episode is that costs should always have a time frame, because in the short run, almost all costs are fixed, and in the long run, all costs are going to be variable. So you have to consider that changes in the level of activity are usually going to have changes in costs, whether these are fixed costs, variable costs, direct costs, indirect costs, or all of my other decisions that I just told you. So make sure to re-listen to this episode if you just think that I threw in a lot of jargon, but if you already feel confident around this jargon, listen to my next episode where I'll be explaining all of the costing methods that we're going to use in managerial accounting. Make sure to share this episode with a friend that wants to learn about business, and give me a review if you like the content that I'm creating. Also, check out my notes on accounting in the description of this episode, and I'll see you next week to keep on learning.